All right, let's talk now about possible market and economic ramifications of the government shutdown. For that, we have Rick Santelli, our CNBC on-air editor, Mike Santoli, our CNBC senior markets commentator, and covering the economic angle is Frances Donald. She's chief economist at RBC. Mike, I want to start with you because yesterday we saw all of the equities averages hitting all-time highs despite this government shutdown. What does that tell you?
Yeah, I guess, Becky, the question is it despite the government shutdown, or is it in part because everybody knows the history of government shutdowns when it comes to the market, and there has tended not to be that much of an impact on balance. In fact, the market has done okay during the duration of the shutdowns, although there is a little bit of an asterisk there, which is typically the market has declined on average into the moment the government shut down a little bit. This time we didn't do that. We're at all-time highs. I think we're seizing on the same sources of upside strength, which is obviously the AI excitement that's got semiconductors going wild, global rallies in all markets, by the way. You look at Korea, look at the rest of the world, and then just the general certainty about where interest rates are, where they're likely headed, and I guess a little bit of a faith that this soft patch that we're seeing in the labor market data and some of the consumer stocks is not telling us that a broader downturn is coming. So I think you put all that together, and the market said, new quarter, same story.
Okay, Rick, explain what happened with Treasury yields yesterday. Yields were a little lower, maybe 6 basis points on the 10-year. Was that because of the government shutdown? Was that because of the numbers we got from ADP, the thought that the Fed will continue to lower rates?
Well, I think it's a combination of your last 2 points. When you get no government data, the data that you do get gets upgraded in priority and significance just because that's all there is. So with a weak ADP and no jobs report tomorrow, no initial continuing claims today, that weak jobs report from ADP and the weak revision made an outsized difference. It really made the interest rate complex move lower in yield because the tone of the Fed is, hey, we're paying more attention to the labor market. Our opinion is it's going to weaken. That data moved in tandem with that strategy, so the market had a big move. So ultimately, the data points we're going to get, like, PMIs, we'll be getting service sector PMIs tomorrow. We'll be getting University of Michigan and consumer confidence numbers. Some of those have inflationary data built in. All those are going to be leaned on more heavily, so there's a risk of some of these data points that aren't really as good as government data, and I'll put an asterisk by good there, but it's going to make a big difference. And the longer it goes on, the one difference that Mike didn't point out here, from my perspective, is the data's never been more important than now because of where we are in the cycle, where all the politics line up. And when I add in the government closure, just purely from the standpoint of debt and deficits, I would think the one market response I would expect, Becky, is the yield curve maybe to steepen. We have $37.5 trillion in debt in this country. We have a $2 trillion budget deficit. We have over $1 trillion a year to service the debt. And what's the shutdown about? The shutdown is about spending more money that we don't have. That's really at the epicenter here. And this is not about a moral argument. I'm not going to have a moral argument about spending money, okay? Whether it's entitlements, all these are highly moral issues that we spend money on. The problem is the logic. If a family has debt and the breadwinner can't make enough money to pay his credit cards, but yet he buys Christmas presents with the credit cards, and then when the bills come due, he can't pay his electric bill or put food on the table, was that a wise choice? And I think that when we see both parties going through election cycles complaining about debt deficits and how much it costs to service the debt, that's the argument we should be having when we have crisis-era special funding that becomes permanent. And it goes back to my final point here. Whenever the government puts a dollar out into the public, it's nearly impossible to pull it back, no matter what reason is given.
A lot to consider there, Rick. I want to get to Frances, and Frances, your job is about to get a lot more difficult if you're not getting the government numbers. And Rick's right to put an asterisk by they're not as good as government numbers. But how are you going to go about doing this?
Can we call you Frances?
You can call me Frances. Anything you want.
You know what that quote is from? Don't call me Frances.
Yeah, what is it? It's
Stripes.
stripes. I was trying to figure out which one.
Don't call me Francis.
Don't call me Francis. I'm not familiar. Well, you'd think that if there was no data that actually we would have a break, but we're going to have to work harder. And that's in part because we have to look at alternative forces of data that are coming through, and we sort of have to put a matrix together of data that is not traditionally what we would use as the guiding light. But for economists right now, I think what we're not so much obsessed with is what is the number going to be for the next month. What we're really looking for is these big thematics that are coming out of this story. What do we do with a Fed that is hyper data dependent when they don't have data? Right. What do we do in an economy where you're increasingly reliant on policies coming out of Washington, and Washington's increasingly acrimonious? And most importantly, this is not the first time when we've been in a situation where we're questioning the reliability or availability of traditional econ data. These are the themes that are really coming to a head in the shutdown discussion. We know as economists the economic data is going to be deferred, not derailed. That's not at the heart of this. The heart of this is how is the economic profession changing, and the shutdown is really a good emblematic element of that.
Okay, that's a lot to unpack too. Guys in the control room, play Mike and Rick to the floor. Francis's IFB box drop. So let's make sure everybody can hear each other here. Francis, let's talk through what's going to happen with these furloughs. Which departments are expected to see major drops or furloughs? I don't know if you expect they'll be permanent. What's the impact you're anticipating will take place on the economy just from the government itself?
The general rule of thumb is 0.1 percentage points for each week, but it is non-linear. And the big number in our mind is October 17th. That's the reference week for jobs. Right. So if this extends beyond October 17th, you will see a big impact to the October unemployment rate. Could be as high as 4.8%. But it's a blip, Becky. Then we're going to get back down to the low unemployment rate environment. This is all going to create some waves for the economy, and it depends really how long it lasts. We're talking about areas that service those furloughed workers. Do they make big decision makers? And at the end of the day, when you're in these periods of heightened uncertainty, we don't anticipate that businesses are going to take big risks. They're not going to know exactly what the policies coming out of Washington are going to look like. So it's really difficult to drum up business confidence. That's harder for economists to measure, but we know it matters, and we know it filters through into the real economy in ways that actually end up being permanent losses to the economy.
Sure. Hey, Mike, I know you said that this is not something that the market is taking much heed of right now because perhaps they think it's going to be wrapped up quickly. If it's not, and we get to earnings season in a couple of weeks, I think less than 2 weeks till we're into earnings season, the uncertainty that you will hear from companies at that point could be something to behold. We had an analyst here earlier this morning talking about how we're looking forward to hearing that. But it could be a very different tone if we haven't seen the government kind of fix this by then.
Probably so, although in earnings season, that's when the market is more fixated on what the corporate sector is saying and doing. Look, we get some of that commentary now. If you look at the kind of anecdotal and the quotes in the ISM reports and things like that, there's been that line of, hey, things are uncertain. We're not willing to go out on a limb with things. I guess from a stock market's perspective, and equity investors collectively, they don't always have the longest attention span or the most distant time horizon. They're thinking, does anything going on now compromise the October Fed rate cut? No, it probably solidifies it even more, if anything. We have a $4.5 trillion market cap company called NVIDIA that goes up 1% to 2% a day. It's hard to get in the way of that. And I do think that even when we get the data back and the government reopens, if there's not been some kind of sustainable macro effect, permanent layoffs, things like that, all of a sudden the data after that's going to be noisy and it's maybe even going to get a mulligan because you're going to be eye of the beholder about it and not know what to make of the overall trend. So I do think that that's an absolute kind of bright side, best case scenario for how this plays. But I think it explains why the equity market is being, pretty placid about this whole thing. And it's just kind of caught up in its own preoccupations.
Rick, what are you going to do in the meantime? Friday, I'd been waiting because we were going to have you give us the numbers. What are you going to bring us on Friday morning at 8:30?
Well, I think on Friday morning at 8:30, what we're going to discuss is how the different jobs data over the last 4 months has deteriorated, how 3 months ago when we had really poor job data, when it turned the corner, how that changed the whole complexion of how the yield curve was trading, how interest rates were trading. So I think we'll do a perspective on history of how weak and what the average amount of job creation has been brought down to. And I think Mike's right that ultimately this probably makes an ease even more likely in lieu of data. I think that the Fed will probably err on the side of being more cautious about not cutting rates. And I think that's a big dynamic to pay attention to.
Francis, quickly, tell me your next number that you're looking forward to that may not come from the government. If you've got to look to other sources, what do you wait for?
Well, I'll give you the number that I'm thinking about all the time, and it's 40,000. 40,000 is the number of jobs the United States needs to create based off of our estimates to keep the unemployment rate stable. So we don't have the jobs number tomorrow, but we did have enough data to be able to estimate it. Our estimate was about 50K. That's more than the United States needs right now to keep the unemployment rate stable. So yes, we do have job growth slowing. We're going to be looking for Indeed postings, LinkedIn postings, all the alternative forms of postings out there. Challenger numbers, which showed some softness this morning. Yeah. But 40,000 is the most important number in the U.S. economy right now. This month, next month, are we doing above or below that number? That's going to be key to the cycle in the United States and key to how markets interpret the U.S. economy.